So again, my name is Blake Edwards, and I am pleased to be joined for this masterclass by Professor Lesley Turner. She's an associate professor here at the University of Chicago, Harris School of Public Policy, and broadly, her research explores the roles that government should play in providing financing and regulating education. And this is also, unsurprisingly, the topic of this masterclass, the causes and consequences of student loan debt. In addition to serving as associate professor at Harris Public Policy, Dr. Turner is also a faculty research fellow of the National Bureau of Economic Research, a CESIFO research affiliate as well. She served as the senior advisor in the Office of the Undersecretary and Office of the Chief Economist at the U.S. Department of Education in 2022, and as education fellow in the U.S. Senate Health, Education, Labor, and Pensions Committee from 2018 to 19. If you have any questions for Professor Turner as the presentation is underway, please feel free to type them into the chat and I will bubble them up to her. And with that, I will turn it over to you.
Well, thank you so much for that lovely introduction. Thank you all for joining me on this, at least in Chicago, it's a very sunny morning. I'll take what I can get. And please do not be shy with your questions. This should give you a sense of my teaching style, which is very much a conversation rather than a lecture. So I'm going to be throwing a lot of information at you about student loans, about my research on student loans, and I would love any thoughts, comments, questions. Don't be shy. Okay, so a lot of my research focuses on higher education, and today I'm going to, in particular, be talking about my research on student loans. My research is very much focused on the US higher education system. And depending on where you're sitting, what country you grew up in, and went to college in, student loans may or may not be an important part of how individuals finance college. But in the US, they are an essential part of how students and their families pay for college. In the US, as is the case in many other countries, there are substantial returns to earning a bachelor's degree or any college degree. Yet many students, less than 60% of students actually complete, and many students do not complete. And so it's really important to understand the extent to which the ways that students finance education and student loans in particular affect whether or not students are able to cross the finish line. In the US, as I mentioned, student loans are an essential source of funding. The majority of students who complete a college degree end up taking on student loans to pay for college. Sorry, this is, let me go, give me 1 second. This is the wrong presentation. It is a very similar presentation, but not quite the one I was looking for, this one. There we go. Okay. So I am going to be talking about student loans, but I want to take a step back first and talk about the context of the US higher education system, so you can appreciate the importance of student loans in the system. So in the US, higher education is served by a mix of public, nonprofit, and for-profit institutions. And so you can see to the left of this slide, the distribution of enrollment. This is in 1 million students across these different types of institutions. Places like University of Chicago are private nonprofit institutions. Schools like University of Illinois in Chicago are public 4-year. A large number of students go to what are often called community colleges. These are public 2-year institutions. And a substantial minority enroll in for-profit private institutions. The US has what is sometimes referred to as a high tuition, high financial aid model. This is a model where the cost of going to college is relatively high compared to many countries, especially those in Europe. Um, and some in Latin America. So you can see in this figure, and this is from the OECD, the typical tuition charged by public institutions. And the US here is in this red circle. So this is US dollars converted so that we can compare across institutions. And you can see sort of across all of the countries displayed here, really only Chile and the UK have similar levels of tuition charged to students going to public institutions. At the same time, in the US, most students get some sort of financial aid. So on the horizontal axis here, you can see the share of students that receive public loans or grants. And in the US, over 80% of students are getting some form of aid. And this is actually a mix of grants and loans, which is quite different than the other countries that are in this high tuition, high aid quadrant. So the UK and Australia, students are very reliant on loans, whereas in the US, students receive a mix of grants and loans to pay for college. And this is very much in contrast to countries in Europe in this group 4 here, where it's a low tuition, low aid model, where college is very inexpensive or even free, but there's not a lot of financial aid given to students. So students finance the cost of going to college through a mix of grants, loans, and out-of-pocket spending. And so this is the this bar here is showing the average cost of attendance. This is both tuition and fees, which is the bottom part of this graph, as well as living expenses. So this is a typical student pursuing a bachelor's degree. They're facing about $10,000 in tuition and fees, and then another $12,000 or so in living expenses. And then the bar is colored in with the average amount of grants and loans students receive, and then sort of the remainder, which is going to be financed through savings and transfers from family members. When we think about now the source of grant aid, so that's the blue bars here, about half of all grant aid is actually coming from institutions. And so that's this sort of largest segment, are institutional grants. And then sort of the second largest category are going to be grants from the federal government. When it comes to loans, however, most of the loan dollars going to students are coming from the central or the federal government. That's going to be the darker shades of pink here. And then a small share of loans are coming from private lenders, states, and institutions. The final feature of higher education in the US is the extent to which institutions face requirements in order to be able to serve students, in order to be able to participate in federal student loan programs. And prior to the most recent OBBBA, there was really limited accountability at the federal level. Schools received a substantial amount of aid from the federal government to give to their students, but really the only restriction schools faced was around the share of students that ended up defaulting on their loans. And these are called cohort default rates. And so if schools had a large enough share of students defaulting on their loans, these schools could get kicked out of federal student aid programs, which often meant that these schools essentially could no longer keep operating because in many cases, upward of 80–90% of revenue these schools received came comes from the federal government. And so these cohort default rate regulations that put restrictions on schools were implemented in the 90s. And you can see that this led to a big change in the share of borrowers defaulting in for-profit colleges. And as I'll talk a little bit later, this was because these regulations led to large changes in the likelihood that these for-profits continue to exist. And ultimately, it improved outcomes for students. Okay. And so this is a slide I went through already. Why studying student loans is interesting and important. In the US, the federal government is the primary provider of student loans and provided about 90% of student loan volume in recent years. The final reason why studying student loans is, in my view, interesting and important is because it's relevant from both an economics perspective and in terms of the policy relevance. So in terms of economics, government-provided student loans are intended to solve what is called a classic market failure. Okay, what is a market failure? Well, when you enroll in the microeconomics course sequence at Harris, you'll learn a lot about sort of the fundamentals of economics, and these sort of hinge on some very strong assumptions about the functioning of the private market. And when these assumptions fail, this is often called a market failure. And so this particular market failure is one where there may be a lot of prospective students who'd like to go to college. They expect to have large benefits from going to college in terms of their private earnings. And this is borne out by research. The typical college graduate earns more, about $1 million more than the typical high school graduate over their lifetime. So prospective students may expect to receive a large benefit from going to college, but they can't finance it out of pocket given the high cost of tuition and fees and living expenses. Students who come from low-income families don't have family resources to rely on to pay for these expenses. And theoretically, they could go to the private market and go to a bank and say, look, I'm going to earn an additional $1 million over the course of my career. This is a pretty good bet. If you lend me money to pay for college, I'll pay that back with interest. I'll come out ahead, you'll come out ahead, and it's a win-win situation. And so at first, this seems like it should work out, and there's really not a role for government to step in and provide funding to provide student loans. But unlike other types of things that individuals might borrow to pay for, let's say taking out a mortgage to pay for a house, students can't offer what they are borrowing for, what we often call as human capital, as collateral against that loan. So unlike a mortgage, where my house that I'm borrowing to pay for serves as collateral, what I'm borrowing to pay for when I go to college is something intangible. My skills, my knowledge, the degree I receive. And even though this is an investment that pays off, it's not something that can be foreclosed upon by the bank. So private lenders realize this is the case and may be unwilling to offer loans because they know once that student has borrowed, has gotten their degree, their skills, their knowledge, that can't be seized, and there may be incentives for them to default on that loan. And so this means that there's a role for government to step in and offer these funds to solve this market failure. And this is exactly what happens in the United States. So in total, there's about 44 million borrowers who have outstanding student debt, totaling about $1.65 trillion. And this is the second largest type of household debt in the United States and the largest source of unsecured debt. In the past, and in particular when I was spending time at the US Department of Education, there were heated policy discussions around student debt forgiveness, whether some or all of this $1.65 trillion should be forgiven. These discussions ultimately led to attempts in the Biden administration to forgive a large share of this student loan debt, although these attempts were ultimately struck down by the courts. And so even though these attempts at broad-based student debt forgiveness were not successful, there's actually a number of other programs that offer debt forgiveness that continue to exist. And so debates about the form and the scope of student debt forgiveness, I see should be ongoing into the foreseeable future. Okay.
Professor
So,
Turner,
yes,
we have a question that came up here.
great.
Pilar asked, are there any papers that estimate the GDP impact of increased federal government funding of graduate studies?
Ooh, that's a great question. So I don't believe there are any in the context of the United States, which is the context I know best. There's actually a relative dearth of research on graduate students and graduate education in the US and abroad. Part of this is due to data availability. Part of this is due to a perception that graduate school is really serving a narrow slice of the population. That's actually not quite accurate. So graduate enrollment and graduate attainment is the fastest growing category of educational attainment in the US. The number of individuals in the US with graduate degrees more than doubled in the 20-year period between 2000 and 2020. And so I think that is a really interesting and important question that hopefully will be addressed in research either by myself or by others going forward. Thank you for that question. Okay. So now that I've talked a little bit about the US higher education system, let me tell you a little bit about my research on student loans. So this research focuses on several points in the evolution of student loan debt. In particular, thinking about how students make their borrowing decisions, thinking about the effects of access to increased student loans on attainment and post-college labor market outcomes, thinking about how students repay their loans, and then thinking about the effects of accountability provisions around how students repay their loans. So let's start at the very beginning and talk about the research on how students make their borrowing decisions. So the first line of this research focuses on students in open access 2-year community colleges. And probably at odds with many of your experiences with higher education in the US, the majority of students attend open access or minimally selective higher education institutions. So these are going to be 2-year schools or schools offering technical vocational degrees, as well as regional 4-year institutions that accept 80 to 100% of students who enroll. How these schools inform students about their loan options can have outsized effects on their borrowing decisions. So when prospective students are considering going to college in the US, They submit an application to the institution, and then if they want to take out federal student loans or be eligible to receive other types of grant aid or scholarships, they have to fill out an application for federal student aid called a FAFSA, free application for federal student aid. The information in this application gets sent to schools, and these schools put together what's called a financial aid package. This financial aid package lists how much the student can expect to pay to attend the college, uh, the sort of direct costs, so tuition and fees, if they're living on campus, housing and meals, books and supplies, and sort of other expenses. So in this particular hypothetical example, the cost of going to this school is about $29,000 per year. This is tuition and fees and the related living expenses. So the first part of this financial aid package is the student's expected cost. And then the second part lists the potential resources the student has access to or may have access to pay for these costs. These resources are going to include grants offered by the federal government, possibly by the institution, and possibly by state government, as well as loans and work study options. And so here we can see that this student is being given a loan offer of $8,000 per year. One interesting thing about these financial aid packages is that when it comes to federal student loans, the school has discretion over what number it gets to list. It can list, in this case, $8,000. It can list $4,000. It can list $0. But in all of those cases, the student can borrow the same amount of money. This is because the student's eligibility is determined by the federal government, not the institution. So the institution has discretion over what it offers, but the offer is non-binding. And what this line of research that I've worked on shows is that small changes in how loans are presented, this is sometimes called how loans are packaged, and in particular, what number gets listed here can have outsized effects on student outcomes. And so in one study with my co-author Ben Marks, we worked with a 2-year community college to look at exactly this question, how the number listed in this financial aid package affects decisions around borrowing. And we randomly assigned students to either see a $0 loan offer, and all of these students could borrow up to the federal maximum, or to see a non-zero loan offer, typically $3,000 to $5,000. In both cases, regardless of what number was shown on that financial aid package, the students still had to opt into borrowing. They still had to actively fill out a form and indicate they wanted to borrow, and then type in the number of the amount of loans that they wanted to borrow. And theoretically, all of these students should have been informed that they were eligible for federal student loans. So all that was varying was this number that they saw on their financial aid award. But the students that saw a non-zero loan offer were substantially more likely to actually borrow. Okay? They saw about a 9 percentage point or 40% increase in the likelihood of taking on any student loan. And so these small changes in non-binding loan offers had outsized effects on whether or not a student actually borrowed and the amount of student loan debt they received. But this also had positive effects on their educational attainment. So it led to significant increases in the number of credits students earned, as well as their grades. So students attempted more classes, they passed more classes, and they earned higher grades. In an additional study, we look at whether the information about student loan options, whether it needs to be conveyed in this financial aid award or whether it can be conveyed through an alternative medium. And so we worked with a second school to send emails to students who'd received that financial aid award, received loan offers, but hadn't made a borrowing decision yet. And we randomly assigned the information students received in this email. In one version, students were just reminded it was time to make their borrowing decision. In a second version, they were also told that they didn't have to borrow the amount that was on their letter, that they could borrow a different amount. And then in the final two emails, they were given a specific number to provide context. In particular, they were told past graduates from this school took on this amount of student loan debt, or past graduates who borrowed took on this amount of student loan debt. And those two numbers were different because one was unconditional and one was conditional. And at odds with what we expected, we didn't see students responding to the information in these emails by changing the amount that they borrowed. We didn't see students changing the amount to be more similar to the amounts of past graduates. What we found instead was when students received an email with a specific number in it, they were less likely to borrow at all. And in fact, they were less likely to take any action, which by default led to them not taking on student loans. And so we saw this as potentially a case of information overload. These students had gotten a financial aid award letter that had a dollar amount in it, and then they received an email that had a different dollar amount. And borrowing decisions are quite complicated. And so what we think happened was that students sort of implicitly threw up their hands and said, it's not clear what amount I should borrow. And so I'm just not going to take any action at all. Moving on to the effects of taking on student loan debt. So in that past study, we saw that when students borrowed more because they saw a non-zero loan offer, they took more classes and they got better grades. In a additional research project, along with several other co-authors, we dive into this result further. And we look at what happened when student loan limits went up, when the maximum amount students could borrow increased. We study the last major increase in the amount undergraduate students could borrow, which occurred in the mid-2000s. Just to give you context, for students that were enrolled at the start of the century, say 2000, a first-year traditional age student could borrow $2,600. And in the mid-2000s, this amount gradually increased to $5,500. Not a huge amount of money, even with the increase, but a substantial increase in percentage terms. We study the rollout of these higher loan limits and think about the implications this has for the total amount a student could borrow in 4 years of enrollment, the expected time to receive a bachelor's degree. And we look at students who hypothetically would have enrolled in particular academic years and then trace out how much in total they could borrow due to loan limits. So if they maxed out their student loans. And you can see here that for students that enrolled early enough, the year 2005 or earlier, if they enrolled for 4 years and if they borrowed the maximum amount they could, the total amount of student loans they would receive was about $17,000. Due to the increase in borrowing limits, as we fast forward, for students who enrolled in the 2008 academic year, so this is in fall 2007 or winter 2008, the maximum amount they could borrow increased to about $25,000. Okay, so about a $8,000 increase in total borrowing. So we look at students who enrolled in cohorts exposed to these higher loan limits. And we compare students who had exhausted their loan eligibility to students who had borrowed but not exhausted their loan eligibility in their first year. And then we looked at what happened when students who had exhausted their loan eligibility in their first year, and we called these credit constrained borrowers, when they gained access to these higher loan limits, focusing on students who enrolled in 2008 or earlier, before the start of the Great Recession. We saw that indeed, when these constrained students gained access to higher student loan limits, they took on more student loan debt, not surprisingly, about a 8 to 10% increase in the total amount they borrowed. Okay, so higher loan limits increased borrowing. But we find that these same students who borrowed more were more likely to graduate with a bachelor's degree. They saw about a 9% increase in the likelihood of earning a bachelor's degree. They earned more after they left college, about a 5% increase in annual earnings. And perhaps most surprisingly, they were less likely to default on their student loans, despite taking on more student loan debt. So they saw almost a 10% decrease in the likelihood of defaulting on their student loans. So despite having higher student loan debt and potentially higher student debt payments after graduating college, they were less likely to default. We think the most likely explanation is that the increase in earnings due to earning a bachelor's degree was more than sufficient to compensate for the increase in student loan payments. Why did this higher student loan debt lead to increases in attainment? Well, we think the most likely explanation was it allowed students more time to focus on school. It allowed them to substitute away from working to pay for college in favor of studying more. And in fact, we do find some evidence that students who took on more debt when they gained access to these higher loan limits were less likely to work while they were enrolled in early years of school, and even those who worked less. Okay. We also find that students shifted away from typically more expensive credit card debt in favor of student loans. And finally, looking at other financial outcomes after college, we see no effects on other types of debt. So it wasn't as though this decrease in the likelihood of defaulting on student loans came at the cost of increases in defaulting on other types of debt, nor do we find any evidence that this higher student loan debt led to reductions in home ownership.
Dr. Turner, we have
Yes.
another question. This
Yes.
is from Gabrielle. And she asks, are you able to speak on the intentions or expectations of the Department of Education with this policy change of the higher loan limits, and were these the expected outcomes of that?
So I can hypothesize, and I think the answer to the second question is yes. So I think the intention was to help alleviate credit constraints students may have been facing due to the financial crisis, at least the second increase in loan limits. So in this study, we focus on students who enrolled before the Great Recession because we're concerned that the Great Recession led to large changes in the composition of students and student borrowers. But at least the second loan limit increase, I believe, was in part in response to sort of reductions in resources households had due to uh, sort of declining financial well-being, a very bad housing market, and at the same time, a reduction in access to private student loans. So banks were less willing to extend credit to borrowers, even though private student loans weren't a big source of student loan debt even before the financial crisis. And so in the same sense that the federal student loan programs overall are intended to solve this market failure and relax credit constraints, the increase in loan limits likely was in this same vein.
Thank you, Dr. Turner.
Yes. Thank you for the question. So one other thing I will note in putting these results in context is that the effects of a $1,000 increase in financial aid are pretty similar, whether that financial aid comes in the form of grants or loans. And so this figure on the right is showing results from the study I just talked about, looking at the effects of higher loan limits and comparing those effects. So the effect of a $1,000 increase in loans on earnings and on bachelor's degree receipt, comparing those effects to the effects of a $1,000 increase in grant aid for a similar group of students. And as you can see, the effect of a $1,000 increase in loans is pretty similar to the effect of a $1,000 increase in grants. And on earnings, the effects are similar, although slightly smaller for loans. And so we think this is additional supporting evidence of the hypothesis that the higher loan limits really were helping students by relaxing credit constraints, that the improvements in educational attainment and labor market outcomes were really due to the increase in available resources while students were in school, rather than, say, higher student loans leading students to take higher paying jobs or feel like they had to work more to service that additional debt. And so from the perspective of the student, $1,000 of grants is almost certainly better than $1,000 of loans. But from the perspective of the government, in terms of cost effectiveness, $1,000 of grants is much more expensive than $1,000 of loans. And so if we're thinking from a cost benefit perspective, it may very well be the case that increasing available resources through increases in the amount students can borrow through federal loan programs will be much more cost effective than increasing available resources through grants.
So Turner, I have a couple more questions here.
Great.
Pilar had a couple more to follow up. The first one, the question is, what was the methodology used to estimate the effect of higher loan limits on student outcomes? Were you comparing 2008 or older cohorts to more recent cohorts? And then I'll get the second follow-up after you answer that one.
Yeah, so we use what's called a difference in differences research methodology. For those of you who aren't familiar, it's essentially looking at changes in outcomes for groups of students for two different groups that were affected by a particular treatment and groups that were not. And so we focus on students who all enrolled in fall 2007 or earlier. And we compare outcomes of those in entry cohorts that entered too early to gain access to these higher loan limits versus those that entered in cohorts that would have gained access to these higher loan limits if they had persisted 2, 3, or 4 years. So that's one comparison. That's one difference in the difference in differences framework. The other difference is between students who had maxed out their loan eligibility in their first year. We call these constrained borrowers. And we compared those to students who had borrowed but still had some available loan eligibility. So they weren't borrowing at the max. And the idea was that for those constrained borrowers, if they did gain access to higher loan limits, if they were in a lucky entry cohort, then at least some of them would choose to borrow more. And that is, in fact, what we found.
And then the second part was, aren't student loans linked? Sorry, try again. Aren't student loan limited linked to average tuition? To understand if the extended loan limit is relatively larger in terms of tuition or not.
No, so this is a very interesting feature of loans in the United States, that the amount students can borrow and whether or not they're eligible to borrow is not at all linked to the cost of college. It's not at all linked to their family income or family resources. Eligibility is essentially universal within very broad categories. And these categories are sort of the year of enrollment. So whether a student is a first year, a second year, or what's called an upper year. And then whether they are essentially a traditional student or an older non-traditional student. And within those broad categories, the amount students can borrow is the same across institutions, across different types of families.
And two more questions have come across. This
Good.
this this slide has triggered a lot of questions. Maxim asked, do you happen to know how government guaranteed student loans have affected tuition since their inception, adjusted for inflation? And they follow up by saying they've seen from data they've seen the tuition in the 60s seemed low enough to be considered manageable to quote work through either through part-time work or through taking gaps between semesters.
Yeah, this is a great question, and I will talk about it a little bit in the next slide. But this sort of idea that more generous federal student loans or federal student grants could increase tuition, it actually has a name. It's called the Bennett hypothesis after a former Secretary of Education who wrote an op-ed basically making this allegation that if you increase the amount students can borrow, all of this will just go to benefit schools because they'll raise tuition. When it comes to undergraduate student loans, there is evidence of pretty small and not uniform increases in prices. So something like 10 to 20 cents on the loan dollar concentrated in for-profit colleges versus in sort of what we think of as the more traditional higher education institutions. I'll talk in the next slide about the price of graduate education because I have research on this question. And
And then, sorry, Lesley, you may be answering this in the following slide, and this is the last question we have here for a while. So, Timothy asked if you can quantify how much student loan limits contributed to raises in tuition, and whether this
yes.
is a vicious cycle where increases in loan limits causes increases in tuition, therefore required increased borrowing.
Yes, the Bennett hypothesis. So for the cost for undergraduates, it's student loan limits do not play a big role. It's the loan limits are quite low. So as I said today, the maximum amount a first year student can borrow is $5,500, which is well below the typical tuition and fees for pursuing an undergraduate degree. And there's evidence of small price responses, but really focused in particular types of institutions. When it comes to the cost of graduate education, however, this was an open question until very recently. So in a recent paper, my co-authors and I study the effect of the Grad Plus loan program, which was established in the summer of 2006. This program created a new borrowing stream from the federal government that essentially eliminated borrowing limits for graduate students. So before Grad Plus, there were strict limits on the amount graduate students can borrow from the federal government, similar to the case for undergraduates, although these limits for graduate students were much higher. And then when this new program was established, it allowed students to top up their federal borrowing up to the total cost of attendance. So that's tuition, fees, and living expenses. And so prior to 2006, if a prospective graduate student wanted to enroll in a program that cost more than the existing federal loan limits, they'd have to pay out of pocket, they'd have to take out a private student loan, they'd have to find some other way to finance their education. After this new program was created, that same student could fully cover the cost of that program through federal student loans. And so we look at the effect of this new loan program on enrollment and access for groups who are traditionally underrepresented in graduate education, as well as attainment earnings for students who were already enrolled when loan limits increased. And unlike the case for undergraduates, where we found large positive effects of access to higher loan limits on attainment, when it comes to graduate students, we saw no effect on enrollment, access, attainment, or earnings. Where we did see effects was in prices, that programs that saw larger increases in borrowing due to the Grad Plus program also significantly increased their prices. When we look at the overall price, it's about a dollar for dollar increase. So for every dollar increase in federal borrowing, the price of the graduate program went up by a dollar. However, some of this additional money was given back to students in the form of institutional grants. And so when we take into account the increase in grants, we see about a 64-cent increase per every dollar increase in federal student loans. So this is a sizable pricing response, much, much larger than what has been found for undergraduate education when it comes to loans or grants. And in I don't want to say in response to this study, but I think in response to concerns about the high price of graduate education and unlimited borrowing, the OBBBA actually eliminated the Grad Plus loan program. So going forward, for the first time since 2006, graduate students will again face strict loan limits for federal borrowing. I'll pause to see if there's questions here.
Nothing right now. Oh,
Okay.
I sorry, I spoke too soon. We had a question from Khalil. The question was, are these comparisons taking into account inflation or the changes in the education? Are the universities also increasing the quality of education slash resources provided to students, etc.?
Yeah, that's a great question. And we wish we had more insight into the resources provided to students. There's just not great data available at the sub-institution level on spending. And so it's quite possible that that 64-cent increase per loan dollar went back to students in the form of additional resources. When it comes to quality, I think we go back to the result where we found no effect on attainment or earnings. And so, it's quite possible that increases in quality wouldn't necessarily show up in increased likelihood of graduation or better labor market outcomes. But we at least can't find any evidence of increases in quality that have direct effects on these outcomes. And unless you think that there's really no room for attainment increases, the likelihood of success for students who initially enroll in a graduate program is actually quite similar to the likelihood for undergraduates. So something like 4 out of 10 graduate students who enroll actually leave without receiving a degree, even if we look 10 years after entry. And the likelihood of degree receipt actually follows patterns that are very similar to what we see for undergraduates. So graduate students who enroll in more selective programs, more selective institutions with higher resources, are substantially more likely to complete than those who enroll in less selective institutions with lower resources. This may seem obvious, but until very recently, there was essentially no data on graduate program completion for those who start. Okay. So in my last 7 minutes, let me run you through uh, two additional lines of research. The first looking at the effects of accountability provisions that are related to how students repay their loans. So I showed a figure at the very beginning that showed loan default rates by year and type of institution. And if you remember that figure, and there's no need to do so because I'll tell you what it showed you, in the late 80s and early 90s, loan default rates for borrowers who had attended for-profit colleges were quite high, something like 60 to 70% of students who borrowed to attend one of these schools had defaulted on their loans within 2 years of entering repayment. Default takes 270 to 360 days. And so what this is essentially telling us is that these students effectively didn't make a payment on their loans. They weren't able to keep up with their loans even within a very short time period. These very high student loan default rates led to the very first federal accountability provisions. And these were these were based on what were called cohort default rates. What these provisions said was that schools where a very high share of students default on their loans could get kicked out of participating in federal student loan programs. And for many of these schools, what this meant was their students would no longer be able to afford tuition, and the schools themselves would no longer be able to operate. And so in this paper, my co-authors and I ask, to what extent did these new accountability provisions affect access to higher education? So on one hand, these provisions were intended to protect students and the taxpayer, protect students from taking on debt that they would never be able to repay, and protect taxpayers from the federal government making loans that would never be repaid. On the other hand, the schools where lots of students defaulted on their loans tended to be open access, non-selective institutions. And so there were concerns that by cutting these schools off, by not allowing them to participate in federal loan programs, this would restrict access to higher education. It would prevent some students who would have gone on to get a college degree and the associated earnings gains, it would prevent them from doing so. And so in this paper, we look at what happens when for-profit colleges lose access to federal student loans. We focus on for-profit schools because the vast majority of those that were hit with these cohort default rate sanctions were for-profit schools. And you can see that in the figure on the right. This is the number of schools sanctioned, and this light blue bar, which is the majority of the each of the bars, are for-profits. And so we look at what happened to enrollment in sanctioned for-profits, in nearby for-profit schools that weren't sanctioned, and in public community colleges, which were the most likely recipients of any students who would have otherwise enrolled in a for-profit school by virtue of being open access and non-selective. And what we find is that indeed, enrollment in the sanctioned for-profit schools fell. We also find what we think are reputation spillovers. Nearby for-profit schools that did not receive a sanction also saw declines in enrollment, even though these schools continued to have access to federal student aid. But we saw that the nearby community colleges saw increases in enrollment and estimate that 60 to 70% of students who would have attended sanctioned for-profit schools ended up being absorbed by the public sector. We don't have great insight into these students' outcomes, except those related to student loans, just due to data availability. But we find that the nearby community colleges, that the students who were shifted to these schools were less likely to borrow and less likely to default on their loans. So at least when it comes to student loan outcomes, these students who were shifted from for-profit to public institutions seem to have better outcomes. Okay. In the very last minute here, I'll talk about one study that's looking at loan repayment. And so this study is a descriptive study where my co-authors and I used administrative data from the US Department of Education to look at sort of changes in the rate at which borrowers repay their loans. And so we calculate what we call a loan paydown rate. That's this formula on the right-hand side, which is just the change in balance, let's say 5 years after entering repayment, divided by the balance the student had when they first entered repayment. Okay. So if you started with a balance of $1,000 and 5 years later you had a balance of $500, then this loan paydown rate would be 0.5, or you would have paid off 50% of your loan. And then we look at how loan paydown rates change for students who entered repayment in 2005 versus those in 2014. You can see in this figure, this is a distribution of loan paydown rates. All of the borrowers to the right, of the $0 point are those that made progress repaying their loans. And those that are fully to the right are those who paid off their loans 5 years after entering repayment. All the borrowers to the left are those that had a higher balance 5 years after entering repayment. So 5 years later, they owed more than when they first entered repayment. And these white bars are representing the 2014 cohort. And so you can see there's a definite shift where a much larger share of borrowers saw their balances increase 5 years later. If we look at the typical borrower, the typical borrower who entered repayment in 2005 had paid off about a quarter of their student loan debt. So they were on track to repay their loans, let's say 10 to 15 years after entering repayment. In contrast, the typical borrower who entered repayment in 2014 had only paid off 5% of their student loan debt. And in the final part of the paper, we look at descriptively what factors are correlated with the slowdown in paydown rates. And we find that increases in the amount students were borrowing, in particular for graduate students, and changes in repayment plans, a shift of borrowers into payment plans that link payments to income, can explain about 80% of the slowdown. So I hope you enjoyed this whirlwind tour through some of my research on student loans. If you're interested in more, please feel free to reach out. And if you enroll, which I hope you do, I offer a class on higher education policy in the spring quarter.
Thank you so much, Professor Turner. Thank you, everybody who attended, for spending time with us today. I'm going to quickly drop a barrage of various links in the chat for folks. Application information, upcoming deadlines, frequently asked question links. I also want to mention we have a couple more upcoming virtual events. One is tomorrow. It's a drop-in with the director to ask questions about the Harris application process or anything about Harris. One is also about, let's see, we get that here, is a getting to know Harris information session, which is on the 4th of February. And then last but not least, if you are in the Chicagoland area, which I see a couple folks are, I know we have a few folks down in Indiana, which are probably like 3 hours away from us. Might be a little bit of a haul, but we have a campus visit this Thursday. So you can experience Chicago in the winter, because it is kind of wintry here right now. But again, thank you all very much for spending time with us today. Thank you again, Professor Turner. And as I mentioned at the top and in the chat, we will have a video. The video of this will be available in about 48 hours. Takes us a little bit of time to process it from Zoom. And I want to be mindful of our time. Thank you all for staying over the extra 3 minutes. And we hope to see you soon. Take care and have a good rest of your day, everybody.